But let's move on then, and let's talk about a couple of other spaces that have been grabbing our attention. We just spoke about the oil and gas space, and we'll get to that in just a bit. But someone who can discuss both those two themes, one is oil and gas, and the other one is cement as well as metals. We have Pinakin Parekh, Executive Director, Metals and Mining, Oil and Gas and Cement at JPMorgan India, who joins us on the show. Hi, Pinakin. Good morning. Thanks so much for joining in. Well, let's talk about the cement space before we get to the oil and gas space. Demand has been very, very strong. The disappointment has come on the pricing front. And this is a seasonally strong quarter, but yet we haven't seen price increases. So keeping that in mind, what kind of an EBITDA improvement are you working with for the industry for quarter 4? And given that input costs have cooled down further, for an industry, what kind of improvement can we see in the first quarter of next fiscal?
Sure. Good morning, Nigel. So for the cement stocks, obviously this has been an unusual quarter. When you have demand growth like this, you normally have price hikes. It has not happened this time, and we attribute this mainly to the slew of new capacities that are getting ramped up across the industry. Industry is seeing a capacity expansion cycle after many years, and the new supply is putting a lid on cement prices. Most of the companies in their analyst calls had indicated a cost decline of roughly 150 to 200 rupees a ton, and that should broadly flow through to the bottom line in Q4 at this point of time. Q4 seasonal is also higher volumes, so to that extent there will be operating leverage. The question obviously is that from here, do we see further large cost declines, which will essentially be a function of petcoke prices? Petcoke prices have cooled off, but again, they remain stubbornly high above $160 a ton. So we need to wait and see whether there's a next round of energy price decline across the board or prices stabilize here at this point.
Okay, all right. But for this quarter, you're seeing around 150 rupees odd improvement is what we should be factoring in for quarter 4.
That is what the companies have broadly indicated in their analyst calls. So at this point, that is what the cost decline looks like.
Okay, all right. The other factor that the street is looking at with regard to cement is that the Adani Group, both the cement assets, they got into a bit of a sticky spot. And then the hope was maybe they won't be very, very aggressive. How are you reading this? Now it appears the group is back on track. If they're back on track and they're not so leveraged at a group level, then they could pick up their expansion plans. That'll be a little bit negative for the industry because pricing power is not there. And then you have the problem of additional supply.
So we would refrain from making comments on individual companies or business houses. But
for the industry,
Pinakin, that the sector is basically... Sure. So for the industry, what we are seeing is one of its kind of capacity expansion cycle. If you do a bottoms up, across the listed and unlisted cement space, there is nearly 100 million tons of capacity addition on its way over the next 2 to 3 years. The industry more or less has decent profitability at this point. Balance sheets are mostly under leveraged or net cash balance sheets. So overall, we see a multi-year capacity addition cycle ahead across players. And I don't think it's about 1 or 2 players. So we need to see strong demand continue on a multi-year basis for profitability hold up, because capacity addition is only going to increase, not decrease from here.
By the way, before, Pinakin, hi, good morning. Before anything else, let me just quickly highlight that we've had our first recovery of the day. Before it completely disappears, let me just put that on the table. The Nifty will tell you that. We got to almost a flat terrain. I mean, 17,130 or so is what the market got to. And now, of course, we are coming off again. So from being down 90, we were down just 20. There was a 70-point pullback, as I said, the first of the day. And that's getting a little bit pressured at this point in time. Surabhi.
Well, Pinakin, before we move on to the oil and gas space, just wanted to focus on the cement space yet again. Geographically, what's looking good? At one point of time, we had North India that was doing very, very well. And I'm looking at your top buy, I think it's on Dalmia, which has exposure to the Northeast and some part of South as well. Geographically, any particular space is looking better than the others?
So let me put it this way. I think what is happening this time is that you have cement demand, which is broadly, stable or similar across regions. And this time the capacity addition is also similar across regions. So I think we are not in a period where regional preferences would be, the key determinant for stock selection. You have a pan-India cement addition cycle. So I think we have to wait and see how prices hold up across regions rather than see whether prices would be better off in A region versus B region.
Pinakin, hi, good morning. Surabhi here. If I could just move to the oil and gas side, because, that sector has become so newsy, so many headlines, right? We were just chatting with the managements of IGL and Mahanagar Gas, and the conversation was on, of course, one, this tariff hike that GAIL has seen come through. But the other bigger change for the sector, the implementation of the Pinakin Parekh committee recommendations on gas. Specifically on gas, how do you see the next couple of months play out, given that we're in the midst of a lot of these regulatory changes and a dramatic fall in LNG prices?
So in gas, there are two events. One is obviously the committee report. We don't know as and when what the committee report will finally be implemented and when will it be implemented. But in the near term, what has essentially happened is spot LNG has gone from $50+ MMBTU to $12, $13 MMBTU. So you have a sudden, increase in LNG imports. Gas cost across the gas consuming industries will lower. We are in the shoulder months, essentially in the global LNG markets, transitioning from winter into summer. So gas prices normally are seasonally lower at this point of time. So if you are a gas consumer for the next few months, you would see costs reduce materially. India's gas demand is price sensitive, and a lot of demand consuming sectors were negatively impacted last year. We saw imports fall very sharply. This will reverse over the coming months. So I think the gas value chain should benefit from lower spot LNG prices, at least for the next few months. But again, this is difficult to extrapolate through the year. We still don't know how Europe's LNG imports will position itself in the second half of the year, whether you have a warmer winter like last year. So we expect LNG prices to be volatile. Right now, they are at the lower end of the range.
Pinakin, you guys put out a report on Reliance recently, highlighting that it's at a very attractive level now. Just talk us through sort of the main highlights, why you believe so.
Unfortunately, Prashant, we cannot comment on single stocks and company-specific events.
Okay. But fair enough. I mean, the stock has done well since that note actually came out, some 5-6% or so in that time period. Today, it's down about 0.75%.
Yeah, that was a big view. Of course, JPMorgan is quite bullish on the stock. So are a couple of others. I mean, we had reports from a lot of other major international brokerages as well, talking about a positive outlook on Reliance. But that apart, again, going back to oil and gas, Pinakin, I think you folks are also constructive on OMCs. And that's because I guess they're reaping the benefits of lower oil prices on their marketing margin side. But what's the outlook on refining per se because of how volatile oil prices have been?
So refining at this point of time, let's break down the product outlook. So this is the year for China's, airline sector. Jet fuel demand should increase very sharply as Chinese go back to traveling. In fact, a large part of JPMorgan's 1.7 million barrel oil demand increase essentially comes from China. So to that extent, the refining outlook is steady. Again, benchmarking it to last year would be wrong because last year was one of its own, events. We are not going to see diesel cracks go back to $60-70 back again. What we need to wait and see is also how the Russian products are getting placed in the market. So far, there does not seem to be any big dislocation in the product market. So we have improving product demand in China. We still have tight supply on the product side. So refining margins should be steady, but again, are unlikely to, to see a repeat of last year.
All right. Pinakin, final question then before we let you go. Just can't let you go without asking you about metals. So what's the preference out there? Ferrous or non-ferrous? And from the ferrous pack, what's the preference within that? Integrated or non-integrated?
So to that extent, okay, so on metals, what we have is, a difference in terms of what is on the ground China demand, which is very strong, and the sentiment risk off in the US and Europe. Chinese demand tends to be positive for ferrous. We have seen iron ore prices remain strong, steel prices move higher. So between ferrous and non-ferrous, we believe ferrous has a better demand outlook, and we would prefer the integrated ferrous companies in India.
All right, integrated ferrous companies in India, a better bet at this point in time. Thanks very much, Pinakin. It's always a pleasure. Appreciate you joining in with your perspective on a variety of issues.